Our next guest says, while the labour market is not too hot and not too cold, we still aren't sure if it's just right yet for the Fed. Joining me now is Chris Rupkey, Forward Bonds Chief Economist. Thank you for joining me this morning. So, as we dig into what we've seen here with these jobs numbers, a few things to sort of factor in. I mean, we had the UAW auto workers coming back into the picture here, some seasonality at play. But overall, what's your big takeaway on this jobs number?
Well, it was clearly stronger than expected. If you take out the auto worker strike effects from October and November, December, 216,000. That's a pretty solid number. In the old days, we used to think anything about the economy creating 200,000 or more payroll jobs per month, that it was, clear sailing and calm seas ahead and stronger growth for the economy. So nothing looks really wrong with the labor markets going into the end of the year. In fact, it looks quite positive.
But then as you look at the revisions that we saw for October and November as well, what should we be honing in on as we look at really the what this means for the Fed and how they should be viewing this, as they don't want to just sort of go by 1 month, especially with these revisions in mind?
Well, the revisions aren't too bad. I mean, it's always quite volatile. They revised down the numbers from October and November, 71,000, I think. That doesn't worry me. I'm looking a little more at wages because a lot of times the markets focus on average hourly earnings, which is the proxy for inflation, if you will, in this report. And we have seen wages going up 0.4%, both in November and now again in December in today's data. So 0.4% is pretty fast, but we just had Fed Chair Powell saying that he doesn't believe necessarily that higher wages stokes the fires of inflation going forward. So I would kind of write off the 0.4% increase in wages, because don't forget, core PCE inflation in October and November barely changed. It was 0.1% each month. So inflation seems to be coming down anyway.
And another number that we're, of course, watching is the labour force participation. Did see that declining. Is that giving us any signals? When you're looking at the different data points, you have an inverted yield curve still, and you look at what we're seeing with this very resilient job market, and people who feel better about having a job also tend to spend more, which feeds into the consumer as well. How do you see that playing out then in the months going forward?
Well, I mean, we've had some gyrations during the pandemic, of course, where the participation rate went down and then is climbing back up. But over time, with the baby boom generation, who are now this year 60 to 78 years old, as a baby boom continues to move forward through retirement, participation rate's probably going to come back down. It went up during the 80s when the baby boom was entering the labor force, especially women, the first time in the 70s and 80s, and now it's on a long-term decline. So I don't make too much of that. They did do a revision to the unemployment rate, which they do every year. And we had seen that unemployment rate was as high as 3.9% in October, but the revisions came through and they knocked that down. It's only 3.8% now. So what we're looking for is unemployment rate was 3.4% back in April. It rose as high as now 3.8% in October. That's not, it's about 550,000 people out of work, which, the markets and the Fed seems to forget. There are people out of work, but the joblessness out there isn't high enough to signal a recession at this point.
And as people have been wondering about, recession concerns here, what does this latest jobs data signal about the enthusiasm that markets had for the potential for a rate cut in March? Does that take that off the table?
Well, we only get two more. Well, no, I guess January, February, March. Sorry, I'm counting. We get 3 more jobs reports to go before that. I think March is a little early. Don't forget the Federal Reserve is a slow, deliberative rule-making body, decision-making body. And I don't think they're going to be forced into it that quickly unless there's something like, higher unemployment or falling payroll jobs. You cannot have a recession without falling payroll jobs, and we simply don't have it. If we look at the yield curve, part of the reason the market's on guard and always sees recession around every corner is the yield curve inverted way back in November 2022. And that said a recession was coming from July last year up through March of 2024. So we got 3 more months before we have to throw away another leading indicator of recession, that is the inverted yield curve. 3 more months to go, and we're still looking for recession.
Indeed. So then do you think it's too early to say that the Fed can stick the soft landing here?
Well, it's looking pretty good. If we continue to get core monthly increases in PCE inflation over the next 4 or 5 months, the Fed and the markets really have the data at their back, given what happened a year ago when there was higher inflation. So at some point before the June Fed meeting, we're probably going to see core PCE inflation with a 2% handle. And that means to me that the Fed's probably going to want to cut rates for the first time in 2024 for this interest rate cycle in June. June would be my bet. March is a little too quick.
Well, certainly we'll see. I appreciate you taking the time to join me this morning. Chris Rupkey, Forward Bonds Chief Economist. Thank you so much. Have a great weekend.